In this chapter, we're going to look at decision making, where the rational decision maker compares the incremental or marginal benefits to the incremental or marginal costs. And if the marginal benefits exceed the marginal cost, the decision maker is going to go ahead with that particular decision. Okay, first we look at what costs are relevant for decision-making purposes. If you're looking at a decision of whether or not to attend university for 1 year, explicit costs, which are outlay costs, things that you actually would have to pay for, such as the cost of books or the cost of tuition, explicit costs are certainly relevant for decision-making purposes. But economists emphasize that also implicit costs that you're not necessarily required to actually make a payment for are relevant for decision-making purposes. So the opportunity cost of your time and effort when you attend college, and what is the opportunity cost of going to class for 1 hour? It's the wages that you might forego when you go to class for 1 hour. So the opportunity cost of your time and effort is something that you don't have to actually make a payment for, but it is a relevant cost in decision making to decide whether you're going to go to college for 1 year or whether you're going to work that particular year. When we loosely define accounting profits, it's the difference between revenues that accrue to the firm minus any explicit or outlay costs, that you would have to write a check for. Economists define economic profit as revenues minus those explicit costs, but also minus any implicit opportunity costs that are associated with that firm. And some of the implicit costs that are relevant for firm-level decision-making might be the money that you use to start up your business. If you're earning a 3% interest rate on that money in a bank and you use that money to start a new business, the opportunity cost, the interest that you forego when you start the business, would be an opportunity cost. Or the wage and salary that you could have earned in the next best alternative might be an implicit cost that's relevant for decision-making purposes. In this example, you quit your job as a lion tamer where you earn $45,000 per year to open your own business, a tanning studio. Okay, so now when you look at the economic profit, it's the revenues from the tanning studio minus any explicit or outlay costs that you have to write a check for. But you also need to include the implicit opportunity cost of that $45,000 salary that you used to earn as a lion tamer. And if you invest your own financial capital in the business, you would also have to include the opportunity cost, the interest that you could have earned on that money when it was in an interest-bearing account. So now when you say that your firm is earning a zero economic profit, it means that your revenues minus your explicit costs minus your implicit costs are equal to zero. So effectively what that means is that you're going to be earning a normal rate of return on your business when you're earning zero economic profit. In this example, you own your own business. Total revenue is $1 million. Your explicit costs, wages to other employees, rents, raw material costs, and so on are $900,000. So your accounting profit would be the 1 million minus the 900,000. So you'd be earning a positive $100,000 accounting profit. Okay, now when you calculate economic profit, it's your 1 million in revenues minus the explicit costs minus any implicit costs that are relevant in this decision. And if you could have earned a salary of $250,000, you would have to subtract that in calculating economic profits. So while you have an accounting profit of $100,000, your economic profit would be minus $150,000. So what that means is the first year that you start your own business, you're actually earning $150,000 less than what you could have earned in the next best alternative. Here again, we look at the implicit cost of financial capital that you invest in your own business. So what is the opportunity cost of that money that you invest in your own business? And effectively, it's the rate of return that you could have earned on that money in the next best alternative. So it's the risk-adjusted opportunity cost that you could have earned. And when you say a firm earns zero economic profit, it means that they're earning a normal rate of return because they're covering that opportunity cost of invested financial capital. When we look at firm-level decision-making, we can look at decisions that are considered either-or decisions, or decisions that are incremental. So in an either-or decision, you would look at the economic profit associated with each of the two alternatives, and then simply choose the alternative that yields the highest level of economic profit. When we look at incremental decisions, in this case, how many dolls should we actually produce and sell? We're looking at a decision where we look at the incremental benefits, in this case of producing one more doll, and we compare that to the incremental costs of producing one more doll. So if the incremental benefit from producing the doll is greater than the cost, then we go ahead and produce that doll. And then we look at the next doll. If the incremental benefit exceeds the incremental cost, we go ahead and produce that doll. So that's how we can approach incremental decisions within this framework. In this example, we're looking at the incremental cost of Alex attending one more additional year of school. So here, what we're looking at is the marginal cost or the incremental cost of the first year of school. So total cost goes from $0 to $30,000. So the marginal cost of the first year of school is $30,000. Okay, then total cost goes from $30,000 to $70,000 for the second year of school. So the incremental cost of the second year is $40,000. Third year of school, total cost goes from $70,000 to $130,000, so the incremental cost is $60,000. The fourth year of school, total cost goes from $130,000 to $220,000, so it's $90,000 in additional cost. and the incremental cost of the 5th year is $130,000. So if we plot these, and we're plotting these at the first year of school, the marginal cost is $30,000. The second year of school, the marginal cost is $40,000. The third year of school, the marginal cost is $70,000. So we're plotting the number of years of school on the horizontal axis, and we're plotting the incremental vertical axis. And then similarly, the incremental cost of the 4th year of school is $90,000, and the 5th year of school is $130,000. So what this gives us is a graphical representation of the marginal cost of attending university for one more year. And when we fit a curve through these, we get our marginal cost curve. Okay, then we're going to compare the marginal cost of one more year of school with the marginal benefit that we derive from going to school for one more year. So the marginal benefit is the incremental or benefit or the additional benefit that's associated with one more year of school. And in this graph, we see that the first year of schooling yields an additional $300,000 in incremental benefits over our work life. So if we plot this point, the first year of schooling results in $300,000 in additional benefits. The second year of schooling produces an additional $150,000 of additional benefits. The third year of schooling produces $90,000 in additional benefits. The fourth year of schooling produces $60,000 in additional benefits. And the fifth year of schooling produces $50,000 in additional benefits. And if we fit a curve through these points, what we get is our marginal benefit curve that's associated with going to university for one more year. This slide allows us to practice these calculations. So if Joe total cost increases from 100 to 110, the marginal cost or the incremental cost is going to be 10. If Joe's total cost increases from 110 to 118, the marginal cost is going to be 18. So you can practice calculating the marginal cost that's associated with Joe producing additional units of services. And we can do the same with Joe's marginal benefits. If his total benefit goes from 0 to 200, his marginal benefit would be 200 minus 0, or 200. And you can see the marginal benefit is much greater than the marginal cost of producing 1 unit of services. So we can go through these calculations. The second unit of output, the marginal cost is 18. The marginal benefit is 230 minus 200, which is equal to 30. So you can still see the marginal benefit is greater than the marginal cost. The third unit of output, here marginal cost was equal to 7, which means the total cost went from 118 to 125, and the marginal benefit is equal to 15. So total benefit went from 230 to 245. Okay, what about the fourth unit of output? Marginal cost is 10. Marginal benefit is 10. So at this point, at the fourth unit of output, the marginal cost just equals the marginal benefit. Okay, then when we look at the fifth unit of output, this would be 135. Marginal cost is 150 minus 135, which is equal to 15. And our marginal benefit goes from, well, it's here, the marginal benefit is equal to 8. So here, marginal cost is greater than the marginal benefit that we get from producing and selling our fifth unit of output. And the same thing with the sixth unit of output. Marginal cost is 20, marginal benefit is 5. So the marginal cost is greater than the marginal benefit. So if we look at this as a decision problem, okay, it's an incremental decision problem. So should we produce the first unit of output? Yes, because marginal cost is way less than the marginal benefit. Should we produce the second unit of output? Yes, because the marginal cost is less than the marginal benefit. Should we produce the third unit of output? Yes, the marginal cost is less than the marginal benefit. Should we produce the fourth unit of output? Well, here, the marginal benefit just equals the marginal cost. So essentially, if we were able to produce units of output that were fractional, we would say yes, we should continue to produce until we produce almost 4 units of output. So the maximizing or the optimal unit of output would be essentially 4 units of output. If we go beyond that, the marginal cost is greater than the marginal benefit. So in this decision problem, we continue to produce output as long as the marginal cost is less than the marginal benefit. If the marginal cost is greater than the marginal benefit, we've gone too far, and we can increase our profits by reducing output. So by this example, there is no unit of output. There is no output that's going to increase profits. If we produce at 4 units of output, if we reduce output from that, marginal cost is less than marginal benefit, so we should go farther. If we produce more than that, marginal cost is greater than marginal benefit, so we should go back. So by that reasoning, the level of output that's just going to maximize our profits is going to be 4 units of output, where marginal cost just equals marginal benefit. And this table states what we have been trying to show in the last slide, that the optimal or profit maximizing level of output is going to be where marginal benefit just equals marginal cost. If marginal benefit is greater than marginal cost, you want to expand output. If marginal benefit is less than marginal cost, you want to contract output to increase profits. So the level of output that's going to maximize profits is where the level of output where the marginal benefit equals cost. And graphically, we can see that in this example. Now we're back to the numbers of years of schooling. And what's the optimal number of years of schooling? We can see that our additional profit, where we take the total benefit minus the total cost, the additional profit is going to be maximized where marginal cost just equals marginal benefit. So where these two curves intersect is where marginal benefit just equals marginal cost at 3 years of schooling. So this is going to be our optimal level of schooling, and that's where our marginal benefit just equals our marginal cost. And you can see if we were going to school for 1 year at this level of output, marginal benefit is greater than marginal cost. At 2 years of schooling, same thing, the marginal benefit is greater than the marginal cost. So we want to expand output in order to increase profits. But if we went out to 4 years of schooling, it's just the opposite. Marginal cost is greater than the marginal benefit. So in order to increase our profits, we're going to want to reduce the number of years of schooling. So it's where marginal cost equals marginal benefit is going to be the profit maximizing or optimal level of output. This slide is interesting because it shows the portion size for a typical restaurant in the United States relative to France. So that in the United States, the portions are 28% bigger at McDonald's, 32% bigger at Pizza Hut, 42% bigger with Haagen-Dazs ice cream. Local Chinese restaurants, the portion size are 72% bigger in the United States. And you can ask yourself the question as well, okay, when you're trying to decide what your portion is going to be, are you comparing the marginal benefit from having a bigger portion to the marginal cost? And if we follow this incremental analysis, we're going to continue to increase the portion size. If the marginal benefit is greater than the marginal cost, we're going to tend to increase the portion size. If marginal benefit was less than the marginal cost, we should reduce the portion size. And when the marginal benefit just equals the marginal cost, you've reached the optimal portion size. And so here the idea is, well, in the United States, the marginal cost of food is probably less, and the marginal benefit of bigger portions might be more than in France if people are used to eating a bigger portion size. So you can ask yourself, well, do restaurants follow this decision rule where they equate the marginal benefit to the marginal cost? When we set up decision problems, it's important to note that sunk costs are not relevant for decision-making purposes. And a sunk cost can be viewed as a cost that has already been incurred and is not going to be recoverable. Or Milton Friedman referred to it as an unavoidable contractual cost. And the notion is, well, if you've already paid $80 for a concert ticket, and that's a non-recoverable cost, meaning that regardless of whether you go to the concert or don't go to the concert, you're not going to get that $80 back. That $80 sunk cost should not be relevant for decision-making purposes. Later in this chapter, when we look at some of the behavioral economics implications, we'll see that it may be difficult for people to rule out like certain kinds of sunk costs, because there might be psychic costs associated with spending $80 on a ticket and then not using it. But in principle, sunk costs are not relevant for decision-making purposes. Economists have typically assumed that individuals and households are rational decision makers, which means that the decision maker is going to choose a combination of outcomes that maximizes their satisfaction or utility given the information and constraints in the problem. However, behavioral economics has asked questions about how rational decision makers really are, and are there limits to this rationality as it applies to model building and economics. There are many examples of decisions where consumers seem to choose an outcome that does not maximize their economic payoff. Some individuals may choose to pay higher taxes in order to provide a basic safety net for other individuals in society. You may choose to have your automobile repaired at the dealership rather than some other mechanic, in part because even though you know that the cost might be greater and the quality might be the same, but the cost of finding someone and the transaction cost involved may keep you making that choice, even though it may not be the one that maximizes your net benefit. Also, decision makers typically exhibit risk aversion, meaning that not only is the expected value of the profits important, but also the variability of profits. Anytime you purchase life insurance or automobile insurance or homeowners insurance, the expected payoff to you is almost always going to be less than what it costs you to buy that insurance coverage. Yeah, and the reason you're doing it is not because you're not rational, but it's because you're risk averse. So you'd rather pay an annual premium than be subjected to a much bigger loss that typically might happen at a very low probability. So insurance companies charge a premium that's greater than the expected loss, and that's why insurance is profitable to them. But because most decision makers are risk averse, it's also in your best interest to buy certain types of insurance. So in the real world, there are many examples of decisions that appear to be irrational, meaning decisions that seem to put the decision maker in a position that's worse off than choosing some other option. And behavioral economics tries to study what sort of the limits to rational decision making are. And it's interesting to look at what types of decisions sometimes fall in this range that seem irrational. This link is one that's particularly interesting in terms of behavioral economists pointing to decisions that appear irrational. Opportunity cost is what you forego when you choose one alternative over another. And many times decision makers aren't fully aware of what they give up or forego by choosing a particular alternative. In behavioral finance, it seems that non-professional investors many times engage in what appears to be risky speculative investing, in part because they have overconfidence in their ability to identify favorable investment situations. So if you think that a particular company is in particularly strong shape, even though it may be a relatively risky investment, your confidence in your analysis may be way beyond what a professional investor would consider to be appropriate analysis. So if you convince yourself that this is really good, you tend to suffer from this overconfidence behavioral implication. Individuals are asked how much money they need in order to retire in the style that they're expecting, and identify situations that might develop along the way. Decision makers typically identify many of the positive things that might develop, but typically do not include all of the unexpected negative outcomes that might occur. And this again is one of the behavioral economic sort of pitfalls that investors and individuals fall into. And also decisions where consumers are buying things using credit cards versus cash. It seems that based on economic theory, if you're maximizing net benefits, it shouldn't matter whether you're paying for something with a credit card or paying cash. But it turns out that that affects many decision makers' behavioral decisions. Now we're back to our concert tickets. If you lost your $80 concert tickets, would you replace them? Yes or no? Now consider an alternative. If you lost $80 in cash that you were going to use to pay for the concert tickets, would you still attend the concert? Answer yes or no. Now ask yourself, well, was the answer different in the first scenario? In other words, would you replace the concert tickets that you were purchased and lost? And would you go to the concert if you lost the $80? So you ask yourself, well, is there a difference between those two? And based on net benefits, there should be no difference. But many times, because of these behavioral components to decision making, individuals don't react the same. And that's part of the reason that the study of behavioral economics and behavioral finance is so interesting. Under what circumstances do decision makers seem to be making irrational decisions? Or putting it another way, what are the limits to rationality in decision models? In behavioral finance, investors are more likely to sell stocks that they have capital gains in. In other words, they've made money in, as opposed to selling stocks that they have capital losses in and they've lost money in. And this is sort of a behavioral component that looks at sort of risk aversion, meaning that consumers and individuals don't like to ring the cash register and lock into those losses, whereas they're more likely to ring the cash register and lock into gains. In this example, you can see that if you calculate the expected payoff, 61% chance of winning 520,000. The expected payoff is 317,200. The expected payoff here is 315,000. In this case, the expected payoff is 509,600. And the expected payoff here is, well, it's actually with certainty you're going to get a payoff of 500,000. So here, based on a sampling of individuals, most individuals are going to be choosing alternative A, which yields the highest expected payoff. But they would also choose In this case, the payoff that yields a lower expected value. And you can say, well, why is that? Well, people, if they're risk averse, may choose to take $500,000 with certainty rather than have a 2% chance that their payoff is going to be zero. And in this case, they did not have a payoff that they knew with certainty, and consequently chose the one that yielded the highest expected payoff. And typically decision makers, when they're talking about decisions that impact a significant amount of income, typically do exhibit risk aversion. For example, when you take out the homeowners insurance, the expected loss that you're going to have. Homeowners insurance, the expected loss from a fire or other damage, the expected cost of that is going to be less than the expected payoff from premiums. So you're going to pay more in premiums than what the expected loss is. But when you pay the premium, you're protecting yourself from a potentially big loss. So even though the probability of your house having a fire is relatively low, the loss from that is going to be extremely large. So typically decision makers are risk averse. European countries, when you renew your driver's license, you're asked whether or not you want to participate in voluntary organ donations. And in Austria, it's nearly 100% participation. Germany, 12%. Sweden, 86%. Denmark, 4%. Like, how do you get these big differences? And it's interesting because if the question is asked, check the box if you do not want to be an organ donor, then, as in Austria, nearly 100% of people do not check the box and become voluntary organ donors. In Denmark, on the other hand, in order to become an organ donor, you need to check the box, and only 4% of the people check the box. In Sweden, in order to become a voluntary organ donor, you do not check the box. 86% of the people do not check the box and become organ donors. So it's just how you ask the question. Status quo. People are reluctant to check the box. And when behavioral economists learn this, when you're filling out an online form, is it going to say, well, if you do not want us to send you emails and promotional materials, you have to check this box. Otherwise, we're going to send you the promotional materials. Then, then firms have learned enough about behavioral economics to know that there's this huge status quo. You ask the question matters a lot. Even though it doesn't take much time and effort to check the box, to think through it and make the decision apparently is having a big impact.